Hello. Hi, I am Megan Brenn-White, the founder and also an associate real estate broker of the Upstate Curious team of Keller Williams Realty Hudson Valley North, and actually more recently, Keller Williams Realty Hudson Valley United, because we just moved into Pennsylvania, and that office is associated with PA. Very exciting stuff. So I am here today with Todd Baker from Cross Country Mortgage. I'm going to let him introduce himself, but we've known each other for a few years now in different contexts as a kind of a committee thing, and then as a client, and then been watching each other do our business for a while here. And he is just he's an extremely articulate, smart person who I wanted to bring on because everybody is freaking out about mortgage rates and interest and inflation. And should I buy? Should I not buy? What's this going to do to the housing market? Do I wait 6 months? If I wait and interest rates go down, are the prices going to go up? I mean, we have so many questions. A lot of people are kind of frozen, sellers and buyers. So I thought we would have Todd come on and talk about also specifically some things that might impact our traditional buyers, which are a lot of people who want to use the home as a second home, or at least kind of a sort of a dual resident between New York City and upstate. So Todd, you want to introduce yourself? Thanks for joining.
Thank you. That's a very nice intro. Yes, we have known each other in various capacities for the last maybe 5 years, 6 years. I'm Todd Baker with Cross Country Mortgage, and I have been in some form of finance, specifically mortgages, for about 20 years or so. I left the industry briefly, but since 2009 to today, I've been working in mortgages in the metro area, in the city. I'm licensed in California mortgages. That's what I do. So I'm obviously intently watching the markets, and I'm intently watching rates, just like everybody else, more so than everybody else, because on a day-to-day, I'm waking up checking where the markets are for my clients and for myself, and admittedly for my sanity. It's been a pretty crazy year for my clients and myself, and certainly for people in your shoes, Megan. So,
and you guys do you live full time in Gardner, or are you still part time?
Yeah, we're like the good classic story of we had the home, we did the back and forth, right, and then the pandemic sped up our long-term plan. Our long-term plan was to be in Gardner full time, or in the New Paltz area, and the pandemic got us up here. Business we can do remote. I still visit clients in the city. And obviously we've talked a lot because I'm doing more stuff in the Hudson Valley and the Catskills and stuff. So yeah, I mean, that's one of the great, again, this year's been challenging, and we'll talk about that, but it's one of the great benefits of our industry, I think, right? You can start another business in another place. So yeah, I'm here primarily, yes.
So it's also good to know that this is from the perspective of someone who's an Ulster County resident. So he kind of has been the kind of buyer we normally work with, has been the seller we normally work with, and gets it from that perspective too. So what is happening, Todd? Why don't we start in January, January 2022?
I mean, I think, okay, where to begin, right? January is a good place. I mean, you had 2 years of unbelievable interest rates, and in some of my shoes, again, going back to the pandemic, wake up, grab a cup of coffee, sit down, can't even get out of my pajamas. There's 70 emails, and just, I want to refi, I want to buy, here we go. Realtors are, just list something, it's gone, right? And it was unbelievable to turn on a dime in January, where the rates just started to soar. They really soared. I had customers where that would call me, I would quote them, let's say 3%. And by the time they found a property or so in February, went into contract, I was quoting them 4%. That's pretty drastic stuff. And then by the time May rolled around, we were talking 5% in some cases. And we'll get in more into the second home and the investment property market. Those were at 6%. And the reason for that, just to address that quickly, is in January 5th, Fannie and Freddie released a lender letter. It's super exciting stuff, Instagram. But behind the scenes, this letter announced that there's two sides of a rate sheet. So there's the rates, that's what people call me for. But there's also points. And to some degree, people 20 years ago would say, the rate is whatever, 5%, but with 1 point, it's, 4.75. You could lower the rate with points. So what Fannie and Freddie—
How much is a point? Do you want to just explain that again for folks who—
Point, for example, is there's a rate side of the rate sheet, and then there's the fee side of the rate sheet. You can buy down your rate, again, let's say it's your 5%, and that's something I will get into later, because I think in this rate environment, paying points, I think is kind of back as a concept. So you can pay points. So 5%. Well, how would I get to 4.5? Well, you're probably gonna have to pay 2 points. And what a point really is let's say it's a $500,000 loan, to keep the number simple, right? That's $5,000, right? And you pay
1% of the
1%.
loan.
And then obviously if it's a half a point, it's $2,500. So on and so forth. People would say, well, why would I pay out of pocket? Well, to lower your long-term rate. Depends on how long you want to keep the house. It also can be a cash flow issue, right? You want to get your payment to a place where, on a rental situation, you've got cash flow. Something I think is more important than rate, frankly, cash flow, in some cases, right? And the other thing is, on a side note, call your CPA. I'm not a CPA. I want to give that disclosure, but those points are considered mortgage interest. So when you pay them, they can be written off as mortgage interest. So you're kind of front loading interest payments that can be written off. So again, I wouldn't say pay points to get a write-off, but you do get a write-off for paying points. So there are some benefits to it as well. And in this environment, more than in a long time, I'm selling points. People have a rate they wanted, rates went up. We can still get there. You got to pay a point, or you got to pay some.
And then with the second homes, how did that change? Sorry, I just got us like totally.
Yeah. Sorry, I was deviating. I was explaining.
No. I realized I was like, please go down this path with me.
Because you want to understand points, right?
Yeah.
So Fannie and Freddie raised the fees associated, or the overlays, however you want to call it in the industry, on second home and non-owner occupied properties. So they didn't really raise rates, sort of inadvertently they raised fees. But most people are not calling up saying, hey, what's your 2-point rate? So you start quoting them the rate that's higher. And that has led to second home. I mean, literally in January and February, I could do a second home that may have been the same rate as a primary residence. May have been just an eighth of a point different. It was like that for several years.
Yep.
Pre-bubble, it actually, there was a market difference. There was actually a difference with second homes, and then it kind of went away. Not owner occupied, but second homes were almost the same as a primary. And so you didn't have that problem in New York. People say, oh, I want to buy upstate. No problem. It's basically the same rate. Okay, great. That has fundamentally changed. It's at least a point difference. If you see, the headlines and they say, okay, your average 30-year fixed is 5.25, which I think the headline's even worse, at least on average. Your second home is going to be in line with an investment property. It's going to be 6.25 in some cases. So yes, that has been doubly impacted by inflation, rate increases. We're going to talk more about that. And then of course, Fannie and Freddie's decision to make that move.
That was like when that was happening. So it was funny because this was, not haha funny, really more just like, funny, but like this was all happening sort of simultaneously. And we actually saw buyers. So first of all, the first thing that started happening was banks were like they were not locking rates when that change was going to happen, or they were just like, hey, we're going to add that later. We have to, but also people were not qualifying anymore. So they got their pre-approval in December, maybe even found a house in January, and all of a sudden it got like way more expensive. And we were actually seeing some deals where people were tight on the debt to income ratio fall all the way apart.
Yes. Yeah. I mean, across the industry, that the line between March and April was a lot of people felt a lot of pain. And, I know personally, I had a couple deals where I'm going to say up front, we were ready, but there was a delay on the seller side. It pushed us into April, and our buyer, my customer, right, had to pay points out of nowhere. Was not very happy about that, but wanted the deal, wanted to pay the points. And to your point, going back to points, on those deals that suddenly don't qualify, that's when a customer can say, okay, if I have the assets, I'll pay the points to get the rate down to make the deal work, right? So you want to lower the rate. But that's where, again, I think a conversation on points is really good, because we're back in those days. I mean, when I first started doing this in 1996, which is impossible to believe, you would sell points because rates were 10. I mean, so I think that's also something to keep in perspective where rates are. You know what I mean? They're definitely not 2.5, 3.5. They're not in fantasy world. That was not, during COVID, those rates were not real. That was crazy. That was market driven. There was a lot there, just like this is market driven. Where we are now on a 30-year fix, for example, is kind of where we were in 2010. It's sort of like the average over the last 20 years.
And I think that, like, I would say that from my perspective, I've literally not heard anybody say that we're going to go back down to rates under 3%. That was really,
Yeah.
it was COVID, it was stimulus. It was, I mean,
Yeah.
that's like waiting for that is like probably waiting forever.
I mean, look, that was great. I wasn't complaining when my phone was ringing off the hook, right? And probably you weren't either. So that's great. But that was literally a windfall in the real estate world, in the mortgage world. The 10-year trend to be more wonky, just let me know. I'll go on down.
No, wonky way. I love this.
But like the 10-year treasury yield had never been below, and that's a benchmark for mortgages. It's not the end all beat all, but it's pretty close. It had never gone below 1.31 before, never. And, you know, a couple of weeks into COVID, it was at 0.5. So it's not like one of those things where we've never been over 1.3. It went, oh, it's at 1.25. Wow. You know, that's a new record. It was insane. It was 83 basis points lower than it had ever been before. So that was not normal. Just right to where, honestly, I know no one wants to hear that because everybody wants to have a 3% rate. 5%, well, that'd be a primary rate, of course. I know we're talking second homes, but where we are now really is more of a normal. You know, at least 4 to 5 is more normal. Those were great rates. If you got that rate, if I wrote a loan for you, or, you know, billions of dollars of loans that were written at those low rates, congratulations. But again, when you buy another home down the road, right, as people do, you're not getting 2.5. You're not getting 3. But let me dovetail that back in and just say that one of the things I wanted to talk about in this market, and you tell me how far you want to go, but basically, I think if there's an opportunity for your buyers who've been out there in the market and they're looking, right, they're ready to go, I think they have to look at cash flow. They may have to consider paying points, which again, you know, let's say a $500,000 loan size, that's $5,000, you know, but it's better than a bigger down payment, right? It'll create a better monthly cash flow. And I do think once this settles, call it 2 years, 3 years, there'll be opportunities to refinance. So I think if you want to get in now and you've got a property, you've been looking, I don't think you throw up your hands and go, well, these rates are crazy. You look at the monthly payment, you see if the cash flow that works, and you say to yourself, in 2 to 3 years, I should be able to refinance this. You know, not at 2%, but maybe at 4. You know, maybe at 4.5.
Yeah. So here's that. Okay. So one other point. Oh my God, this is like so hard to not make a million jokes here, but the points are normally rolled into the mortgage, right? Isn't that what most people do? So it's not like you're not.
No, I mean,
some people pay out of pocket for them.
It would pay out of pocket. It would be added onto your closing costs.
Okay, so you cannot roll it into the mortgage. That is.
Don't roll it into the mortgage.
Okay, great. Good to see. Look,
I mean, there's situations, there's FHA loans, there's different things where portions of the closing costs can be rolled in. But if you do a 20% down loan, for, you know, and you want the terms associated with 20% down,
paying
25, you can't roll more in or you're above that threshold. So you're not rolling those in. Those are coming out of pocket. Again, like I say, you're creating cash flow. So there's numbers I'll run for clients, like break evens. I'll say, look, here, you know, you're at 5. Let's use second home rates. You're at 6. And you're going to pay this point, and this point is going to get you to 5.75, right? And then we'll look at what the payment difference is, and we'll say, okay, well, the payment difference is $300, and then we divide that into $5,000, and say you're going to recoup that. You know, quick math, they're going to recoup that in what, 3 years? I think that's right. So there it is. So you've paid the point, you've created this cash flow, and in 3 years you're going to recoup what you spent, and it's tax deductible. By the way, you're not technically spending as much as the 5,000. You're going to get some back on the back end. So I'm not saying points are this wonderful, awesome thing. I'm saying there's something that are now relevant again where they weren't before. If you could get 3%, no points, you weren't paying points.
Well, yeah. So, okay. So, God, there are so many ways to go with this, but I wanted to say a couple things. Is that one is that, so one of the bad things for buyers during the last couple of years have been that all of us have been so busy, we've been barely able to breathe.
Sure.
You know, and I would say that is true for appraiser, like title search, contractors. Like one of the things that I think people miss is that the refinances, that was a huge part of the business of people doing cash out refinancing, taking that money, renovating their homes. It's like, it's
Yep.
like that, it's like we know that was happening because COVID and people wanted a home office and they wanted to make their home nicer because they were there all
Sure.
the time.
Sure.
But I think people didn't realize how much stress that was putting on the entire system of buying a home, of renovating a home, of getting your loan, of all of that stuff. So I would say that's another, to me, that is another huge advantage, that like we're getting title back more quickly. The attorneys are not like, oh, you know, like it's just everyone is a little bit like just more able to just do the job and like get it done in a timely fashion. And you might even be able to find a contractor or someone to do a roof or whatever, because those renovations are slowing, like they're finishing, and people are
Yeah.
not going to be they're not refinancing from a 3% loan into a 5.5% loan to do a cash out to do a reno project.
They shouldn't.
Generally not, you know.
Generally, bad idea. You're totally right. The efficiencies in the system are there. It's just unfortunate it has to kind of come to this, right? I mean, refis are down 75%. So they are not, I mean, across the industry, that is just a whopping number. So there's a lot more. Yes, attorneys are picking up their phone. I'm picking up my phone. You know, it's not like I never didn't want to pick up my phone, but sometimes you can't pick up your phone. Now you can, right? You can do these things. And I think, again, that's your side of the business, but obviously I pay very close attention to that through the realtors I work with. I know more listings are coming online. Prices are flattening. It took some pretty drastic stuff to make that happen, but it is happening. And so that's how I feel. I think, this is my humble opinion, if you're somebody who's not in the market, but you really want to buy, right? I don't think this should scare you. You just have to do a lot more homework. Before it was like, hey, Todd, let me get a quick pre-approval at 3% because I want to go buy this thing. You know, that was what it was before. Now I think people have to ask themselves some pretty basic questions. You know, how can I pay for this? What's the cash flow? Can I handle this for a period of 2 to 4 years, right? And then refi as things settle. I mean, again, let's not start Saturday talking about like the war in Europe, right, or whatever. But that is the very
that's real. That's a big part of this.
It's a variable that we can't account for. But the general forecast, most economists think that the measures that are taking place right now will bring things back to normal, probably next year. But that's not to say that you have to wait till next year to buy, because I think once mortgage rates move to where they move, they're going to stay there for a second. You're not suddenly going to go, we beat inflation in May and rates are at 4. It's just not going to happen, right? I mean, so they're going to be there for a minute, and then if we get back to some normalcy, we'll see them come back down. And so if you're already out there, people working with you and they're already in the trenches and they're doing all this work, keep doing it. I think keep doing it. Hopefully more things come online. That's my opinion of it. And again, you talk to people like myself to help crunch the numbers and figure out how to make it happen. And again, if you pay a point, you pay a point. You do an arm, to your point, and we can talk about that too.
Would you because I feel like I've also, you can again tell me if this is true or not, but I feel like I have heard people say that they think rates will likely go back down into the 4s when inflation settles down, because we're sort of addicted to low interest rates now in the housing market, and competition, that's like
I think, well, you look at Europe, like for even the United States, we were very reticent to raise rates. And then finally Powell was like, okay, we got to do it. So in June and July, these inflation numbers that came out Friday are not going to change that in any way. In June and July, we're going to see a 0.5 point rate hike. So we're going to see a point go up. Now, a lot of that's already priced into the market, admittedly. So it's not like he's going to push a button, they're going to raise them, and then all of your rates are going up 0.5%. That's not how that works. But obviously, it marks the trajectory of rates. So ultimately, yes, you're going to see them rise. I had a guy, I think I made him very sad, but he was looking at a property, and he said, "Hey Todd, what rate should I use for my spreadsheet to figure this out?" And I said, "You should use 5.5." This was on a primary residence, and he said, "Oh my God," and I tried to break him down. I said, "The difference on the loan you're looking at is like $200 a month. Can you swing that difference?" That kind of thing. So I think you've got to work with a good mortgage pro. There's one here, but honestly, if you've got it, when you work with them, they'll crunch the numbers. That's the fun part of the job. Looking over people's tax returns is not the most fun part of my job. Believe it or not, sourcing bank transactions is not my favorite part. Working with the clients and figuring out how to do the deals. And again, it's been great, but the last 3 years, you haven't had to do that a lot. People had good jobs, good credit, rates were low. It's like, here you go. Here's the thing. Now people have to really think it through. They really have to work it through.
I think, again, like there's like 15 things I want to say or ask, but one of the other things that we're seeing, interestingly, that again, this is like kind of where our lives intersect a little bit, is there's the loan that the bank will give you, and then there's what you can actually afford, like what in your gut you feel like you can afford. And what we saw was a lot of people just being like, well, we'll buy a house, we'll Airbnb 3 months out of the year, and then it's cool. Cause like, so as long as the bank will give us money, we're good.
Right.
And because there are so many Airbnb regulations coming up in different areas, I know
Sure.
that we are advising clients, like, do not, if that $200 a month, or if whatever, do not count on that money. Basically count on, like, if you need to roll back to doing a monthly or seasonal rental or long-term rental or whatever, like those things you can still count on, but like the short-term rental easy money is this kind of stopgap. I honestly wouldn't bet on it anywhere necessarily, not for the long term. Discuss.
Yeah, couldn't agree with you more. That's, as you know, but since the audience doesn't, that's how me and my wife Raquel were able to come up here. I guess we could have swung it, but the plan was, let's renovate this old house, let's Airbnb it. And it was great. We had the calendar, so we could make sure we were there a lot. I would say two parts. Yes, regulations are coming. Again, if our audience doesn't know, I know I was part of a group that was trying to fight for the rights of short-term rentals. But I did learn a lot in the course of that. And I did change my position. My first position was kind of like, it's my property, get off my yard, to, okay, I get it. I'm having an impact here and I've got to be conscious. So two things. If you need the Airbnb income, if you're just some investor play, I wouldn't do it. If you want to be part of the Catskills, the Gunks, if you see yourself, as we did, actually making this your future home or being very involved in those kinds of things, I think it's totally worth it. Because one thing about these regulations is some towns are unreasonable. There's no question. But some towns are reasonable. They'll say, look, if you're a primary resident, or if you have a responsible steward who's watching over the property, that we can like keep on file, right? So there are some. Again, there's some towns that have lost their mind. I can't comment on some of the laws that are crazy, but in our town, it started off crazy, and I think a real dialogue happened, and we were happy with it. But it took a lot of work, and there were a lot of times when I was like, I think they're going to shut me down completely. So
Yeah.
that's not a reason to do it. I think is that's a great investment. The upstate is booming. I don't think so. I think it should be. You want to be part of the community.
Your interestingly, your situation actually is the kind, like in a previous situation, in a two-family place, is the kind that is still allowed most places, because you could
correct.
One of them is it could qualify as owner occupied if one of them is owner occupied. And I do think it's less, longer term perspective, it looks like actually this, and this is whatever, different conversation, but like the Supreme Court actually might rule some of these local regulations. Like there are cases that are going up to that level at this point. That may change it back to like kind of a free-for-all, and like you can do whatever you want with your property. But in the meantime, I would say that towns that have regulations, weirdly, would be, in my mind, less risky than ones that don't, because it takes them a while to get to the regulations. So once they've got them, I think you can assume they're going to be like that for a little while.
Yeah.
But it is interesting how many, like I would say that literally probably 90% of our clients want to do that at least some of the time. Like it's not like a small percentage. It's like, and I think it's a great idea because to me, like somehow, I don't know, ethically, morally, whatever, having a vacation home that you use 30 days out of the year and it's vacant the whole rest of the time, no one's using it, no one's spending money in the community, whatever, is not as good as having a home where people who can't afford to necessarily buy a home up here yet can come, they can learn about the community, they're spending money, they're enjoying it. It's like, we talk about fractional ownership kind of a ton of things, like
Sure.
kind of being the way of the future, and Airbnb is actually a way.
I agree. Obviously, if someone's going to have a second home and it's just going to sit dark most of the year, that I don't think that's a good thing either. Going back, I've really come a long way with this conversation, because I started with, hey, they're going to pass a law. No, you're not. And I'm going to, rail against it. And I still mostly believe in the concepts, but the responsible stewardship and those kinds of things have to go hand in hand with it. But I 100% agree. Just having somebody go, okay, fine, I won't Airbnb it, and I can afford to just have this house, and it's, I'm going to go up in July, and maybe go there for Christmas, and that's the house. Like, that's not great either. And it's like the chicken or the egg. You can't stop someone from buying a house. You can pass a short-term rental law, but you can't stop them from buying a house. So they're going to buy it. And there's plenty of people with plenty of means to let a house sit dormant. So, I mean, it's the short-term rental thing is a fascinating conversation. And I have to say, I've come a long way. I don't know if I think it should be a total free-for-all, which is a total change for me.
Yeah,
from the
same.
start, where again, it was like, get off my property, leave me alone, whatever. I've come a long way on it. It's a complicated issue, but all I would say, my takeaway on it is, I agree with you for qualifying purposes. If you need the Airbnb, if that's your whole thing, I wouldn't recommend doing that. I don't, from an Airbnb standpoint. And if you're just doing it because you think Upstate is this great investment play, I wouldn't do that either.
And you guys don't, I mean, no banks count Airbnb, potential Airbnb income, or do you?
Yeah. So yeah.
Can you use it for actual qualifying? That's
so not Airbnb income. So actually cross country mortgage, my employer will love that we've transitioned into this because this is a product they like to talk about. But they do have it's an amazing, now the rates are a little higher because it's an out of the box program. So again, we have to come back to a rate conversation higher than where we even are now, right? But that's the reality of one of these out of the box, non-QM, non-qualified mortgage things we're talking about. But yes, we do have a program where it's not Airbnb income, but it is that appraisal's done and an estimate of how much rent could be, obtained on a monthly basis. And that can be applied to your qualifying income before you've even rented the place. So yes, there is a product like that. It's an investor product that we have.
So you guys, just so you understand the power of this, because I think that I bought a house recently as using a similar loan, and I was like, wait a minute. Basically, it means so as long as okay, and correct me if I'm wrong, as long as the estimated rental income, long-term rental income is higher than the cost of the mortgage, essentially, and interest, insurance, taxes, whatever. Essentially, if you get the down payment, you can qualify for that loan.
Correct. Correct. And it can be used in conjunction with your income too. So if you, let's say you don't really have the income, this can be added in, to supplement, to get you over the hump. You know what I mean? To qualify your ratio. So yeah, so it's income you don't really have that gets calculated in based on the presumed rental income. So
which is smart, which is really smart.
It's a smart product. And again, I was in the big bank space for a long time and had a lot of success. It was great. One of the great things about being here is, for example, I'll just do a quick plug, but there's programs here where we can just do, you're a 1099 employee. So you're a freelancer.
Yes, talk about that. And literally, so many of our clients have very weird tax returns and employee situations.
Yeah, so 1099, obviously, you give that to your accountant, and your accountant does what accountants do. You bought shoes? That's a work expense, right? Whatever. You had a salad, they write it all off.
Yeah.
You drove your car, that's all too. So at the end of it, yeah, you made 100,000, but then your accountant, you made 10 grand at the end of the year for taxes, right? Works great when you're filing your taxes, but then not so great when you apply for
great.
Yeah. Like 10 grand a year, I can't do anything. We have a 1099 program where the tax returns are not required. I just need your 1099s. It takes that completely off the table. Again, caveat, because we're also talking about
interest rates.
For interest rates, because this is a non-qualified mortgage program, but it's out there. It's doable. Let's say you're a self-employed business owner, same thing. My wife is a restaurateur, right? So at the end of the year, the accountant, at the end of the year, she makes whatever on paper.
Nothing. Zero.
All we can do for 2 years is take her business checking account, and we can actually just use the flow of funds in. Tax returns are off the table, flow of funds into the account. It's like a bank statement program.
So how much would that be, a percentage point higher, or was it more than that? If it was 5.5 for normal, what would it be?
I mean, to be candid, you'd probably be at 7 with a point or two. I mean, it's, the rates are high. But again, if you're somebody who can't qualify and you want to buy that property, let's say rates were 4, right, where everybody would be happier in general. That program is going to be more like 6, but again, this is a non-qualified mortgage. You're not walking into any credit union or bank or any of these things and getting it. But I would say this isn't some subprime nonsense. This is fundamental. There's a fundamental underwrite that goes into it. Obviously, we know that if you're cash flowing, $1.5 million through your business, and even though your accountant says you netted 25 grand, we can do an underwrite that builds a different profile for you. So these are great programs. Again, we're talking a different rate environment. We're definitely going down a rabbit hole of even higher rates. But I got to give that caveat because I don't want someone, to say, "Oh my God, it's amazing," and then be shocked by the rate. The rates are different.
And again, like this is like to me one of the. So when I see that Emily is mentioning here that she used Visio, which does the rental income, I got a loan from Post Financial, which was a mess, to be honest to God truth. Like the interest rate was up a ton. Like it's a total no doc loan. It's like, again, they're basing it on Airbnb income. So they use the Airbnb, but we've had, I don't want to be like slandering people, but let's just say that like we've had a number of people switch from that product to other ones at the last minute. And if I could have, I would have, because it was such a mess. But it is one of these ones that is a significantly higher interest rate to be able to get into something, which can make sense at times. It really can.
No, and just quickly on that note, there are traditional programs with better rates where I can build a case for Airbnb income. It's almost like a small business. So for example, if you have a couple years of Airbnb income, again, if you're properly reporting it on your tax returns and we can document the payments and we can document future bookings, we can use that for income.
So if the history would be of the house that you're buying. So if there were different, so like if it had existed as an Airbnb for 2 years, or if you have,
for example, okay, you're right. Actually, that's a better context. If you're buying it outright, you're probably going to be in this investor program if you can't qualify. But let's say you're somebody who has an Airbnb and actually does another one. I'm saying you have a track record. Because I believe you have Airbnbs. Yeah. So if you were somebody in your shoes, you wouldn't have to do a crazy program. If you have 2 years, you've reported it on your tax returns, and I see future bookings, I can use that like rental income because you have a track record. It's all really track record, for that type of program. Yeah.
So much fun. I wish I had called you. Anyway, so Jose,
we're here now.
It says, what's your view on variable rate loans, 10-1, for example? I think that is a big question.
Love them. The only loan that I ever did on different properties I had until rates were like, insane, and I locked in a 30-year fix at 3. Like that's great. Not to rub it in, a lot of people did. Those were 2 years of just unbelievable rates. But I always did ARMs before because I felt like, the rate environment, I can refinance at some point. 10 years, people, 30-year fixed is the standard. It was forever. It's what our parents did and so on and so forth and on down the line. It's a little antiquated. I think 10 years is a good period of time. People sell homes, people move, people are definitely more mobile, people are remote. 10 years is a good window where you do a 10-year ARM. Some people do 7-year ARMs. I don't have a problem with that. I think it's all about your time horizon. Are you realistically going to have this house for 30 years? Do you need to lock a 30-year loan? This is a primary residence, but I just locked the client in 3/4 of a point lower than the 30-year fix on 10-year ARM. That was just yesterday.
So just to be clear, so these are loans that like a 10-year ARM means that like you have it for 10 years and then it can adjust. Right. And the rates for those are always lower than.
I mean, depending on the yield curve, there's times, but yes, in general, yes, that's true. There's been times when the yield curve was upside down and it wasn't that big of a savings. But right now, yes, it's probably, a 0.5 point, 3/4 of a point. So, to not use jargon, let's do whatever. If the rate's 5.5, just throwing that out there, you could probably get a 10-year ARM at 4.75 or, 5 and 4. So there's definitely savings. Of course, that's going to help people qualify. The reason the 10-year ARM, and this is definitely more mortgage wonky, so follow me here. The reason the 10-year ARM is better than, say, a 7, right, is because 7-year ARM uses a qualifying rate. So when you qualify, let's say your rate is 5%. Those loans, the lifetime cap is 5% higher than where you start. So it could be as bad as 10. They qualify you at 10%. That's your qualifying rate.
So basically you have to, with your current income, afford what it would cost per month at a 10% interest rate. Oh yeah.
Correct. So if you can do that, God bless, but if you can't, then the 10-year ARM gets you out of that qualifying rate and allows you to still enjoy the low interest rate because it's a time frame. As I've said many times, it makes a lot of sense. I mean, 10 years, that's, a decade is a really long time. So it's enough time, most likely to refi at some point, maybe sell, maybe like, again, like a lot of people took advantage of cash out. 10 years is an awfully long time to have a fixed rate.
And I think the average,
Yeah.
people sell their homes on average, I think it's every 7 years. So it's like, so the 10 years is beyond the normal,
Mhm. And
the normal time period.
Average mortgage is something like 6 to 7 years. You know what I mean? So mathematically, just from a reasonable standpoint, it makes perfect sense. Again, I'm not saying a 30-year fix doesn't make people feel good, or maybe if you're a middle to lower income first time buyer, it makes you feel better. I got 30 years at this rate, and I get it. I'm not going to try to steer someone out of their comfort zone. But in this market, where people really can still buy, and they say, well, the 30-year fix is up a half a point. Let's talk about the 10-year aren't, because it's where the 30 was now, right? So that's the conversation we're having. And then again, going back to points, I like how we're taking old stuff and bringing it in. But to go back to points, now you can do the 10-year. Maybe you pay a point. Now you're even lower than you were on the 30, so your payment's even lower. So those are the things you have to. I mean, again, you can do these yourself. Some of these calculators on Google, I get it. But I got to make a living. No, I'm kidding. I mean, you want to have a professional run these for you, and any good mortgage professional worth their salt is going to run these things for you and enjoy it. This is the part of the job that I love the most, helping people figure out how to do the deal, educating them a little bit on some of their options. So yeah, I'm a big fan of ARMs, adjustable rate mortgage. Again, fixed for 10 years. On year 11, typically it's either a 1 year or a 6-month relock period, and that's based on index plus a month. So it resets after those periods of time. But again, most clients never get to that 11th year. You know what I mean?
So I think sorry, we're managing dog situation over here.
Yeah.
Crazy dog. So one of the other things I wanted to bring up, actually, which is kind of interesting, and this also fits into, like, there are some ways to buy, have a lower rate, either the 10-year ARM, 10-year ARM plus points, or to look at your income in a different way to qualify. I don't know how. I haven't kind of figured out how much this is impacting the second homeowners here yet, but I do know that nationally they're saying that one of the causes of the lack of inventory, it had been that sellers can't find a place to buy because the market was so competitive, but now it's still competitive, still low inventory. But on top of that, if they have a 3% loan and the house that they're looking at to buy is going to be 5.5%, it's a huge jump in your monthly cost on top of a market that's gone up over 30% in 2 years.
Yeah, it's expensive out there. Yeah.
So what would be like, so the only reason we're kind of seeing this. The only reason sellers are selling is because they want to, for personal reasons, like they're moving away. They're like, it's normal.
Sure. I mean, getting someone to sell, I can see that being a problem, because you do have to turn around and buy. And like you said, if you're locked into some 30-year fix, even if you've got a ton of equity in your house and you stand to have this windfall of money come in from the sale, you got to go buy something. You got to go live somewhere. So it's people who are relocating. I totally agree. That is, again, my business has been very tough. That's a conundrum that you guys are in. I think it's really, again, going back to my cash flow comments, which I've said over and over again about as many times as I've said points, is, it has to be something where you look at it in a greater financial plan and you look at what can work for you. I mean, I guess I would say this as a mortgage person, and I often say my least favorite part of my job is rates, right? Because I have no control of them. I can give you a great loan experience. I can tell you a lot of stuff, and then the rates are the rates, right? But I think if you have a significant amount of equity in your home and you're going to get this windfall, if there's a way to keep the windfall and buy into another place and the cash flow works, right? Then you have the money. There's only one way there's two ways to extract money from your property, right? You got to cash it out, which means you're paying even more interest, or you sell. And then you can use that windfall to buy. Maybe you do a bigger down payment on another place.
Yeah. Yes.
Yeah.
That would be the way. That would be the way to keep the monthly payments the same.
Right. Yeah.
So actually, anybody who has a 3% interest rate or lower also is generally sitting on a lot of equity right now, unless they bought like 5 seconds ago. But like if they bought in 2020, like the early part of the pandemic when the prices just started rising,
sure,
they do probably have a lot of equity that they can then put into the new home to keep the
Mhm.
rate somewhere that they feel comfortable with. It's, I think it's funny. It's like on both sides of, for both of us,
Yeah.
for all of us, my team included, it's like, it just goes back to like, why are you buying this house? Like you said, like, do you love this area? Do you want to be part of the community? Do you want to like enjoy more time outdoors? And what can you afford?
Right. Exactly.
And it's just like normal, you know what I mean? It's kind
Yeah.
of like, don't like, and instead of being like, I have to get out of the city, like here's $1 billion, like go, you know?
Yeah. Again, I agree with you. It's a tough situation. I mean, to your point about people sitting on a lot of equity, there were a lot of cash out refinances that happened too. So people have eaten into those equity positions too. You know, those rates were pretty tempting. So to my point about there's only two ways to get the money out. You know, if you had a place that suddenly is worth $1 million and you only owe like 400 on it, you're thinking 3%, that actually lowers my rate even on my current mortgage, and I can pull out 300 grand. I'm going to do it. So the equity positions aren't there either. You know what I mean? In some cases. So when you say to somebody, do you want to sell?
Yeah.
Somebody's kicking the tires. It's like, well, now
I can't.
You know what I mean? I'm borrowing at 3% after taxes. It's probably a net effective 2%. Like, no, so that's a tricky
and this was also, I think that this was, you know, again, talking about like how everybody was like all frantic with refinancing, but the cash out refinancing, the other thing people did with it was buy other homes. They weren't just renovating.
Yes.
So this was a lot of the cash buyers that we saw in the market were people who did take advantage of the lower rates and got like this house I'm sitting in right here. I bought for $250,000 in 2016, and we put money into renovating it. We built another little outbuilding, but it appraised at 814, and I did a cash out refinance and just got like this ginormous chunk of money and like bought a couple more properties. And I was like, and it's because at those rates, I mean, that I was still at 2.9%.
Right.
But you are 100% right that like in this market, I'm not sure I could sell this for that price necessarily. And even if I did, I wouldn't, it's not like before I would have gotten a windfall. Like I've had my windfall.
Right.
And I've borrowed against my windfall.
You borrowed your windfall and then you bought other properties that are income producing. So that's a great play. I think now, I think the market is going to get better next year and so on and so forth. But I don't think that's to say that people can't buy now. I think it's just living in a new reality where things are going to be slower. So I think, again, more conversations can be had. We're not buried in our work, you know, those kinds of things, setting up maybe for a sunnier day. But I think there's still things out there I think it's about purchasing. You know, this cash out thing, like you say, those kinds of things, they're not going to be there. Let me ask you this, just to flip it back, because I read and I hear from other realtors that inventory is coming on the market, but is it just, dribs and drabs, or is it something you feel is a fairly significant thing that is a kind of a market mover, or?
It's so it's funny because like I just saw there was an article in the Bluestone Press. I read all of my local papers today about the spring real estate market, and one of the brokers was saying how like in the town of Marbletown, which is Stone Ridge and High Falls, basically there's like 21 houses for sale when there normally would be 80. In the town of Rochester, where I live, Cohasset Accord, there's like 18 houses for sale. Like it's just the inventory is still so low. What we're seeing is I think what we're saying is that and I guess basically the point about inventory is that in a weird way, we've also been using that phrase incorrectly in a way, which is that like it's just that more inventory is coming onto the market, but it's just still selling super quickly. So at any one point in time, you look at the market and you have 2 seconds worth of inventory left for people to buy. What we are seeing is people getting pickier. So buyer, like the amazing house, the kinds that we list that are like perfect and beautiful and great and or have like amazing potential to be flips or whatever, those houses are still absolutely getting, like we're seeing buyers agents also losing multiple offers again and again and again still now in June. Houses that anything people would have been annoyed about before, they're back to being annoyed about. So it's like, I can't make it look good. It's like, I don't know, the roof might be leaking. We're actually having, it sounds so stupid, but like we're actually having buyers agents on my team are negotiating post-inspection again. which was just not like a thing. Like before you'd be like,
Right.
great, you want to negotiate? Amazing. I have 5,000 other
Yeah.
buyers right behind you who will pay more already.
Mhm.
And now the sellers are like, okay, I'll kick back like 5K for like
Right.
your
A
fireplace.
return to normal. Like
Yeah.
drastic circumstances have created a return to normal. And again, it just it's a flip. And I knew in 2020 and 2021 when my phone was ringing off the hook that it would not be that way forever. I did not think from January to June, it would be
Yeah. It was a little dramatic.
dramatic, right? It was very dramatic and shocking. But I think, that's the whole point of this, trying to quell inflation. It has to be pretty shocking. We're going to get stuck in some stagnation.
Right.
And obviously, whatever, we can go down that rabbit hole. There's going to be one person in the New York Times or some periodical that says it's all going to be okay, and some other guy that says it's the end of it, right? But this is why this happened so drastically. I think is to curb these things that were great. You could take advantage of them, and now I think you have to sit down, crunch the numbers, see if it makes sense. Some of the things we touched on earlier. And again, they have to leverage people like you, Megan, and they have to leverage people like me. I think customers do to decide about buying, and then sellers, exactly. They have to see if it's the right time for them to sell, because I could see it being a tough time to sell. I could see it being a tough time to sell.
I would even like to say that people really in this market have to leverage people like my team and you, because in the previous 2 years, like we have such a big reach, so we can get your, we always can get your house exposed to people who are not necessarily looking in your area and get interested in But you also, like, now you have to be smart in a very different way for both of our jobs. Do you know what I mean? Like, so like working with people who are following the market, who are following the trends, who are like, know actually that, like, this story is a national story, and it's also a local story. So there's like there are particular homes where I would be like, you know what, this could go down 50K in price next year. We have no idea. No one's expecting things to go dramatically down. This house is sick and you're not going to find another house like it. Just go ahead. Like, do you like it? Great, buy it. Like I am all for, like, I always have said this, I'm all for, even if you think you are overpaying on a home, but it fits into your plan. None of us know what things look like 5 years from now. None of us. So you're like, I don't want to pay this interest rate. This price is too high. Great. Do you like the house? No, because the people who waited just saw prices go up and up and up while they were waiting.
Right. No, you're right. And again, it shouldn't be a pressure thing. It should really be like a conscious decision. And you look at the conversation I had yesterday with the client that I mentioned about the 5 versus the 5.5, and oh my God, now 5.5 doesn't fit my profile. Then, and again, maybe I'm being a little dramatic or harsh. I don't think I am, though. Then you should stop looking and wait a couple of years, because you're either going to have to find a place you like and swallow it, and maybe try to get creative with a 10-year arm, or pay some points, or just say, hey, for 3 years I can handle this payment, and wait for a sunnier rate profile. Or I think you've got to hang it up. I also think there's that too, right? I mean, from your side of the business, there's people who are looking, and if they're that sensitive about rate, it's like, this isn't the time, right? It's like an investor, it's been great. You just throw some money in a stock and, oh my God, it goes up because, magic's theory, right? I mean, we're in a situation now where you've got to be smarter. I think you've got to lean on professionals, to your point. And I think that you have to look at a timeline where refinances come back. I think it's all so dire. Everything feels so dire to some people. The rates are just going up. They're just never going to stop. That's not true. And to your point earlier, the entire global economy, we don't have to get to a scale of that level, but is so dependent on cheap money. You know what I mean? The entire, for better or worse, the entire world is addicted to cheap money. Right now, it can't afford cheap money. I think I was talking about it earlier. The US waited probably too long to act, and Europe definitely too long, and they're still just inching. They're afraid to really just, grab it. And of course, there's a war on the, on the Eastern Front. But that's a different story. The point being is, this is going to be a painful little process here, and people are going to have to make really hard decisions about what they want to do. And I'm with you. If you see a great house and you want it, you should get it, because you will be able to refinance in a few years.
And you will be able to, and also you, like, I always thought that we have a question here, but I always think that, like, the chances that, like, this area is changing so much, and the work from home trends are, a lot of them are staying. and the area is changing, like getting more amenities and everything else. So the odds that the prices are going to go down dramatically versus going up dramatically, like I'm going to bet on going up dramatically over a longer time period. The odds that the prices might go down a little bit in the next year, maybe, but for that particular exact house that you want, maybe not, because again, the area is getting more and more attractive and bringing in new buyers. So I think it's always like, does this house work for me and my plans? Period. That's like literally all you need to know, like pretty much, because none of us can actually tell the future.
Exactly. But I mean, you know, a few months ago, the number was that across the United States, inventory levels were 1 million units short. Guess what? We're not going to make up 1 million. It's not going to happen.
Well, and some of them, realtor.com says 5.8 million in terms of like the gap between.
I thought the million was crazy, and you're saying 5 million, right? 6 million. So again, I think, you know, it's whatever, I don't know, it's the old adage, whatever, buy land, you know, they're not making any more of it or whatever. Like, there's not some builder movement that's going to happen. Put enough homes out here to change it. To your point, this area is changing, you know, for better for a lot of us, right? For worse for some, whatever, everyone has an opinion. But you're right. There's amenities coming. There's different things that are happening. People are obviously already knew about the area, but then I think the pandemic opened people's eyes. They came up and said, oh my God, you know, this is gorgeous. Remote work is now something that, you know, employers are it's being built into the negotiation. Yes, you can come in twice a week when you can work from home. So these are the things that are going to make it more possible for people to be here, which is going to only increase demand for, again, a product that I don't think is going to come spilling onto the market anytime soon. So I agree with you. You have to, again, consult a professional, do your cash flow analysis, and make sure it makes sense. But you can't be in fear. Oh my God, I could have had 5%. Oh my God, I could have bought it for 50 more or less, whatever.
Or you can't live in the past, because if you actually thought about what prices were 2 years ago with the interest rate, you will freeze up and never buy. I saw that happening to people in Brooklyn. Like I saw the same thing happen there, where prices were going up and they were like, wait, but in 2008 it was this, and it's like, well, now you're missing the rest of it, you know, like, so.
Well, and the last time in this area, and I knew this from the short-term rental stuff we did a lot of research there. The last time prices in this area, you know, they were moving up. Then you had the crash in 08, right? You had that happen. They went down and they've been going up ever since. So would they have gone up as fast without the pandemic? I think not, but they would have kept going up. There's no reason for them not to. And I think, I mean, I guess, but maybe somebody who's crazy would hope for some, you know, horrible financial downturn to where it come back. But again, that doesn't necessarily mean you would get the houses either. Somebody else would swoop in too. None of that guarantees anything. You see the house, right? If prices suddenly went down, there'd be even more buyers coming in to take the house. So it doesn't work that way. You know, if you see a house and you're out on the market, that's what I said in the first part of the call. Go for it. That's what I said to the client yesterday. Go for it.
So we're almost at 11 o'clock here. We have like a somewhat specific question from Tara, but I'm gonna so what I would say is that, like, if everybody else wants to, like, we can stay on for this question, but anybody else who I have put Todd's the link to his website here, and you can and your Instagram page, like, so if the link from my Instagram page includes his Instagram thing that leads to his information, you know, but if you just Google Todd Baker cross country mortgage, you're gonna find him.
I can also do this too.
Or your email.
Just an email. So it's there. So you probably have it up, but like anybody can reach out.
Yeah. And you can always ask me if, you know, you can write to us and we'll be happy to get you in touch with them. I don't know, Tara, it might be interesting. So I feel like let's stay on for your question, but I just wanted everybody else to, like, know that they don't have to stay on. They don't want to, you know, so not that we're keeping everybody.
Nobody leave.
No. But yeah, thank you. I mean, I think this has been, I mean, I love talking about this stuff, and you guys, when people say that real estate agents
want to talk about this stuff, nobody wants to talk about this
I
stuff.
know. I was just gonna say, I was like, people think real estate agents just like open the door and let you in, and that's what you do.
Yeah.
Like,
No, there's more. I will say, in defense of realtors, not that they need to be defended, but, you know, I'll have clients who are like, I'm looking online and this and that, and I'm always like, get a realtor. You know, what are you doing? Like, what are you doing? These people do this all day, particularly buyers that don't have realtors. I totally don't understand, but sellers as well. because you guys just have so many resources, so much knowledge, and it's really whatever. Maybe I'm pandering to my audience because realtors are a big part of what I do, but you guys are, you know what I mean? It's important, and I can't understand on either side of the transaction operating without them. It's crazy, to me.
No, and I will say, like, our team is like, I feel like we're just like learning we're like this big like hive mind, like learning every day from every transaction, every lost offer, every deal
Sure.
that falls apart, every deal that comes
Sure.
together. And we're just like, what do we do if this happens? What do we do if this happens? What do we do if this happens? And
Sure.
like,
Yeah.
It's really, it's not as easy as it looks, I think. So,
Yeah.
All right, Todd, ready for Tara's question?
Yes.
The house in Nashville that has risen in value, we got it in 2018. I'm going to read this because I don't know if everybody can see it. We got it in 2018. I want to do a cash out refi, but we were on forbearance for a while and got a lower rate post getting off of it. They have a 3.125% interest rate. Question in 2 parts. When is the best time to do a cash out refi? I would think the higher values on homes now would be great. 2, will doing a cash out refi giving a higher interest rate? Give us a higher interest rate than 3.125.
Yes.
Yes.
Okay. So, right? Yep. So I think we addressed this a little bit, but sort of in broader terms, but this is just an example of exactly what we were talking about. And a lot of people, I'm actually visiting some friends this weekend and I'm staying with them at their house. And they were doing the forbearance thing like so many people through the pandemic. They're restaurant owners, there was pain points there for sure. And they came out of it and were offered this amazing, refinance. Just at the end of the forbearance, that all rolled into the loan. Really, really good stuff. And they're at like some really great rate as well. If you're at 3 and an 8, I don't know if there is a good time to cash out, to be quite honest with you, at this moment, because right now you can't cash out for less than probably 5%, and that's probably a generous rate, but let's just say 5%. Again, you could pay points, you can cash out with a 10-year arm, maybe you'd be in the low 4s. But again, the way that cash out mortgage works is your current principal that's at 3.125, which is pretty sweet, is now all going to be at 4, 4.5%, 5%, along with the cash out. So there's other vehicles. There's home equity loans. Again, those are based on prime, which I literally just said is going up another point. So the question with cash out becomes, what's it for? Like I said, you got to have it right now. And how much do you need? If you need like 50 grand in your balance, which I don't think was discussed here, so that's important. But let's say your balance is $300,000 and you only need $50,000. Doing a cash out is something I wouldn't recommend anyway, unless you were getting a better rate, which you're not going to get. So again, I think cash out when you need it. Let's say rates were 4 and the current rate was 4.5. I would feel comfortable.
Yeah, that's fine.
You need the money. And again, if you owe 300 and you want to borrow 200 more, okay, cool. If you only need 50,000, 25,000, 70,000, I think a home equity line, right, or some other form of, that's really your best bet would be a home equity line.
You know what's weird? You know what I just thought of though? I mean, and correct me if I'm wrong, but like, okay, so let's say Tara, let's say those guys have 3.125%. They do a 10-year arm, they get 5% on that house, and they're doing it to buy a second home or an investment property, which otherwise would be 6.5%, 7% possibly.
Yeah.
For that, it would make sense actually.
Yes. I mean, I think that's why. Possible.
But again, not for 50K, but like if they could get out like 500K and just.
No, I think Tara's question brings us back to what I said. I think you have to be consulting professionals. For example,
yes,
it's a great question. It's fine. Out of context, I don't know. You know what I mean? So to your point, yeah, we want to buy this place, but rates are insane over here. Let's do a cash out here. So you can. So for example, a second home, right? We discussed the rate's going to be 6 plus. I can do a cash out at 5. Bingo. That's now you can cash out to do it. So there are scenarios where it still makes sense, and that's why it's not always about rate. It's about the scenario. Which again, I think is a nice dovetail to the end of the whole conversation, because this question in a vacuum is really, the answer is I wouldn't cash out right now. Rates are high. But what do you want to do with it? How much do you need? How much can you get? These are conversations that you have to have one-on-one with the pro, I think.
Because the other thing that again, like the other thing that we did, we got the money from here. We bought, sure, less expensive places in cash, and we can wait it's actually it's like the opposite of a cash out, like of refinancing. Like we can
Right.
like, we're going to wait till rates go down and then get mortgages on those places.
Exactly.
Be able to do
Exactly.
stuff. So it's like
But if you needed the money now, or you could find a program where, again, whether it's points or some other thing, where you could get money now because you wanted to make a move on a great investment. Again, you do the cash flow analysis, you see how it fits, and you don't say to yourself, oh my God, it's 5%. I just can't do it. You say, well, 5% is kind of the median interest rate over the last 20 years, and I can afford this. I'm going to do it. And you kind of work inside the market that we're in.
I just got one more question about how cash buyers are feeling in this market. So different cash buyers, I would say that investors are getting, the investors we work with that are often cash are, and this is actually a pretty small portion of our business. And this is where I would say that my short-term rental feelings have changed. So people who are buying like a ton of short-term rentals in one town, and that's like, they don't care. They're just like wherever. I do not feel great about that.
With you.
So so those guys also, they are leaving. They're the ones who are kind of like, they are pulling out, they're like not as sure anymore about the return. And if there's oversaturation, if people are going to go back to Europe. So for a number of reasons, I would say that some of the investors and are getting more, ones who are getting loans and ones who are not, are just getting a little bit more skittish about the market. Cash buyers, if they are cash buyers just because they have a bunch of money and want to buy a great house here, it's amazing for them, because if it's a little bit softer and there's a little bit less competition and you could maybe negotiate an inspection, it's weirdly still a great time to be a buyer or a seller, especially because if you have a great house, we're going to get a million buyers. If you're a buyer, you have a little bit more flexibility on the homes that are anything other than the flavor of the week. So so it depends on the person, but yeah, we're still seeing cash win a lot of the time.
And that's, again, I said mortgage applications are at a 22-year low. There's a reason as well. What I always say, I'll just throw a quick plug in though, if there's cash buyers watching this or whatever, to just tag that onto my part of the business. We do have delayed financing, or what we call technical purchases too. So if people want to pay cash, to win a deal, but they actually, really want to do a mortgage, despite the rate, or whatever they want to do, a 7-year, 10, whatever they qualify for. I'm seeing a lot of that. Make a cash offer, it gets accepted. You call me, we do an application, and then you close in cash, and then we close not long after a mortgage for you, right? So you win the deal. You don't have all that mortgage contingency going on. There's obviously, I think, the myth that a cash deal closes quicker than a finance deal. I don't know if that holds up. I've seen cash deals take forever and be a mess, but you close in cash, you win the deal. People love cash. Cash is king, and then we can come on the back end and do a mortgage for you as well. And you'll get a purchase rate associated with it. That's why they call it a technical purchase. So there's ways to do that.
That's interesting. I didn't know. I mean, yeah, that we've also had people who say that they waive the financing contingency, but they're still going to apply for a loan. So it's like, so they're applying for the loan and they're like, great, if I lose my job tomorrow, I go and buy a yacht and I mess it up or something, or I just don't qualify, then I have to pay cash, and you have to show that you have enough cash. But like, everybody knows they're actually trying to get financing. But that's interesting to do the delayed one. So
yeah, we do it at the same time, and you can even lock, so you can lock the rate. Obviously, in this environment, locking rate is obviously, something. It's also something we can do. We can lock even before you have a property. There's some bells and whistles there. We, again, could talk about one-on-one, but there's definitely ways in this rate environment to do some crazy stuff. I mean, if you can pay cash, good for you. You can also go back and refinance and get that money back.
What I want to do, just as a final wrap up thing, is like, and this is, I see Scott, who was on the team working in marketing. We definitely need to email this out, because this is a very dense topic, and I feel like there's a lot here. I think, Todd, if you could also give Scott just a couple links to be like, whatever you have that's useful, that's like, here's the rate lock thing, here's the 10-1, anything that you think that we kind of talked about that people could read a little bit more about. I think that would be awesome, because we didn't get a chance to talk about the rate locking one, and I think that kind of stuff is definitely going to be interesting to folks. So
yeah,
I think we can do that, do that just a little email to everyone. So
a little follow up to this conversation. I'm with you 100%.
Yeah, awesome. Well,
yeah. So yeah, absolutely, be happy to do that.
All right. Thank you so much. This was great. And yeah, we'll see, watch this space. We'll see what happens. Maybe we'll be back on again in a few months and we can talk about it.
I would love to. Thanks for having me in the first place. It's really great to talk to you always.
Same. All right. Take care. Bye.
See you guys. Have a great weekend.